Now let's go to Nigeria's biggest story. Was the 25 basis point haircut in the country's benchmark lending rate by the Central Bank Monetary Policy, citing softening inflation, a steady path of economic growth, headlined by the rebased second quarter GDP 4.23% released on Monday by the data office. Let's listen to the Central Bank Governor Uwaleke Cardoso a few hours ago.
Decisions of the MPC. The committee decided as follows. 1. Reduce the monetary policy rate MPR by 50 basis points to 27%. 2. Adjust the standing facilities corridor around the MPR to plus 250 to minus 250 basis points. 3. Adjust the cash reserve requirement, CRR, for commercial banks to 45% while retaining that of merchant banks at 16%. Also, to introduce a 75% CRR on non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision to lower the monetary policy rate was predicated on the sustained disinflation recorded in the past 5 months, projections of declining inflation for the rest of 2025, and the need to support economic recovery efforts. The MPC also adjusted the standing facilities corridor to improve the efficiency of the interbank market and strengthen monetary policy transmission. The committee further introduced a 75% CRR on non-TSA public sector deposits for enhanced liquidity management. Considerations. The MPC expressed satisfaction with the prevailing macroeconomic stability evidenced by the improvements in several indicators. These include the sustained disinflation, improved output growth, stable exchange rate, and robust external reserves. It particularly noted the increased momentum of disinflation in August 2025 being the highest in the past 5 months. This deceleration, underpinned by monetary policy tightening, exchange rate stability, increased capital inflows, and surplus current account balance have helped to broadly anchor inflation expectations.
Get more insight into that monetary policy decision and what it means for Nigeria's commercial banks, especially the trimming of cash reserve ratio to 45%. My guest on this is Abuja Studios, Professor Uwaleke. He's an economist and the president of the Association of Capital Markets Academics of Nigeria. Great Tuesday evening to you, Professor. We thank you very much for making the time on the show tonight. This is as hot as it gets, what I should say, right off the press. Give me your first word on the central bank rate decision today. Good evening.
Yes, I think I commend the CBN's MPC for at least that signal they have sent out. They have the future stance of monetary policy, cutting the MPR at least to 27%, even though the MPR is still elevated at 27%. And for me, more importantly, adjusting the asymmetric corridor. So now what we'll have is a symmetric corridor, plus 250 minus 250. which to me, just as the central bank governor argued, will help interbank relations. And of course, the issue of the CRR again, the high CRR for commercial banks that was reduced from 50 to 45%, is a welcome development that will inject, improve the liquidity that we'll have in the banking system. And for me too, I find highly commendable the introduction of the 75% CRR for non-TSA public deposits. So what that means now is that banks will now be discouraged from chasing government deposits and compelled to mobilize private sector deposits and lend them more to businesses. I think that's a step in the right direction.
Interesting. So the central bank monetary policy communique read by the governor cited weak inflation and economic growth path for the rates adjustment. Do you agree with those points as the basis for these haircuts?
I absolutely agree. If you also notice, I'm sure it's also in response to global trends. We are more or less in the season of rate cuts. We've seen that in the US, the Fed, cutting rates, the Bank of England, Indonesia Bank, and recently the Bank of Ghana. So against the backdrop of disinflation, sustained deceleration in inflation rates we have seen, and against the backdrop of stability in the exchange rates, improved liquidity in the forex market, and of course, healthy reserves. Reserves touched $42 billion recently. So central bank feels a lot more comfortable, with the level of liquidity in the forex market. So against all this, it stands to reason that the central bank, should begin to ease or at least send out that signal that it's now in a position to, change monetary policy stance.
So it's been 2 years of Uwaleke Cardoso on the saddle, the central bank. Do you think it's done fairly well, in the manner of speaking, in terms of inflation, holding, trying to manage inflation, and again, try to give some measure of support to the macroeconomic side of things to get us to this point in which we can cut interest rate, not just the headline interest rate, but also trim what you call the CRR for commercial banks to 45%. Do you think it's done a fairly good job?
Yes, I think he has. I think I rate him high. If you look at the mandate of the central bank, which is primarily to maintain monetary and price stability, again, to be able to answer that question very well, we'll have to also see where we are coming from. A very unstable, macroeconomic environment, and of course, lingering impact of, COVID-19. So I think he has done fairly well. The fact that since February this year, we've had, as I said earlier on, sustained, decrease in inflation rate. And from all indications, we expect that inflation rate will, taper further, even if it doesn't touch the 15% target we have set for the 2025. And if you also look at the exchange rate, of course, that is where I think he scores very high in the sense that if you look at what he has done since he came in, clearing backlog of forest commitments, and also ensuring that reserves are built. When he came in, net external reserves was very, very low, abysmally low. Today we hear net external reserves is of course, as a last count, more than $23 billion. Of course, we know that gross external reserves today stand at around $42 billion, enough to finance over 10 months of merchandise imports. So when you look at all these indicators, you can only but score Yemi Cardoso a pass mark. All right. Of course, you can also talk about financial system stability. The fact that banks are also, in terms of financial system stability, the bank's financial health indicators are also strong.
Yeah, okay, so anywhere in the world, when central bank cuts interest rate, it tickles the market, tickles the common man in terms of what will be the rate at which I'll get credit at the banking sector. So the CRR, the central bank, even under Uwaleke, also had maintained CRR very tight for commercial banks. Up to today, that's down to 45% for commercial banks. Those for investment banks, or what we call the merchant banks, are retained at the previous level. So do you see some good news for the banks in terms of their balance sheet and all of that? Not just the MPR, but also the CRR trimmed downwards. Professor?
Well, I see some good news in the sense that the banks will now have more money to lend. I expect loan-to-deposit ratio to improve, considering the fact that CRR has now been reduced for commercial banks. So I also, of course, on the flip side, you would also expect that declining interest rates would also mean a reduction in the interest income that banks have been leveraging on. A lot of banks profits have also been as a result of increase in the interest income. Of course, when you have a reduced interest environment, that will also that may affect that. But by and large, the fact that they have more money to play with, particularly in the to lend, would go a long way to rub off positively on their bottom lines. And if you also check the corridor that has now been reduced, okay, the corridor we had before this MPC is, as I said earlier, on +5. Okay, +5 means the central bank was actually lending them at 27 plus 5. That's 32%. So now that the corridor has been reduced, it means they can get these funds cheaper, and they should also be in a position to lend cheaper. So using volume or turnover, I want to expect leveraging volumes on turnover. Whatever they're getting by way of inflows should also improve.
So the central bank, the monetary policy decided to say, look, we're cutting the CRR for banks to 45%, but also tightening the non-TSA. So go chase the private sector. Make sure the private sector, this is engineering growth for private sector in the manner of speaking, ensuring that the banks...
Yes, engineering growth. Yes, I agree with you. It's engineering growth. Again, you also know what the central bank is targeting. Part of the pressure we have seen, particularly in the forex market, has come from these public sector deposits. Each time we had FAC allocations.
Exactly.
You find exchange rates responded almost immediately. So I think the central bank has taken note of that, and the central bank wants to discourage banks from mobilizing, chasing government deposits, because that is what usually puts pressure in the forex market. And that's why I think what is happening is a way to penalize banks that rely on those deposits, to discourage them from chasing those deposits, and as I said earlier on, compel them to look more in the
Professor, I'm sure you remember, Professor Uwaleke, those years of what we call armchair banking. I'm sure you remember those in the 80s and the 90s. What we call armchair banking in those. Yes. I'm sure you remember very well.
Yes, armchair banking, cheap funds, cheap deposits,
cheap government funds.
So now keeping such deposits will now be. Exactly, they're not going to be very expensive. They're not going to be, unprofitable because you are packing. Remember, the 75% you are packing with the central bank is interest doesn't attract interest. So those funds are literally sterilized with the central bank. So as I said earlier on, it's really to discourage them from doing such.
All right. So you have big banks such as Zenith Bank reporting decent earnings. So far this year, the first half. So walk me through the key line items for you in Zenith Bank, for example. I'm sure you saw today the massive numbers coming through from the banks in terms of what investors are trading. Of course, you're also a chartered stockbroker, so I'm sure you keep an eye on the market every day. What do you see as the impact of the central bank rates moving forward into the full year 2025 when you go by what Zenith Bank, for example, has released over the last few days into the market street?
Well, I think it's going to be very positive. Interestingly, you see, my principal place of work is Nasarawa State University, but I'm also a visiting professor to University of Abuja. And interestingly, the last lecture I had with the MBA students, executive class of the University of Abuja, what we were analyzing was just the financials of Zenith Bank. and some other banks. And for Zenith Bank in particular, what came out, from the analysis done by the students, jointly, is that the current share price of Zenith Bank is underpriced, if you like. As at the time we did that, Zenith Bank's share price was 63 naira. I think that was on Saturday. 63 naira was Friday. And today, Zenith Bank's share price is closing at 67 naira. So that should tell you, something. This is a bank that just in the first half of, this year, reported gross earnings, to the tune of 2.5 trillion naira, increasing from 2.2 that we had 2024 to 2.5. And largely, of course, the interest income they are contributed accounted for, grew by about, 60%. And this is also a bank that, despite provisioning as much as 760 billion, naira in terms of the forbearance that's, to exiting the forbearance regime, was still able to report profit after tax of over 530 billion naira. And of course, the result of all that is the bank has now declared a dividend of 1.25 kobo. And if you look at what other Tier 1 banks are doing, one of them declared 25 kobo, dividend, interim dividend. Another one just declared 1 naira, interim dividend. But Zenith Bank has done 1 naira 25 kobo. And if you also look at what happened last year in 2024, the interim dividend was 1 naira. Final dividend was 4 naira for Zenith Bank. The total was 5 naira. So one should expect that for the full year 2025, the shareholders of Zenith Bank should be expecting something higher. And if you take other metrics into cognizance, the fact that the prudential ratios for Zenith Banks they are quite good, well above the regulatory thresholds. The non-performing loans, which the measure of asset quality, declined from 4.7 to 3.1, between December and June. You also have liquidity ratio coming in at 69%. Industry regulatory threshold is 30%. And then capital adequacy ratio, as high as 26%. And when we did our calculations, we realized that return on equity for Zenith Bank, is more than the industry average, at 24%. So interestingly, I have some people in that class, in that MBA class, who tell me they are shareholders of the bank. And one of the questions I asked them when we were doing the qualitative aspect of the analysis, and I was asking them if Zenith Bank were to come to the market again to raise funds, would they invest? Would they? They said, of course, they would gladly do so. Last year, you recall, when Zenith Bank came to do a public offer and a rights issue, those were oversubscribed. So that tells you the level of confidence that even the shareholders have in the bank. And again, we also have people who say they are even staff of Zenith Bank. And I also asked them questions about staff management relations, and they tell me staff morale is very high at the moment in Zenith, and staff promotions come as at when due. So all of this I think point to a very bright future for particularly those shareholders of Zenith.
Yeah, I'm sure you're not just teaching students; you also know how to trade and make money. So it's a very interesting balancing, isn't it? So the classroom is enthused about the market. So in terms of what the outlook is for the rest of the year.
Yeah. I teach. I teach. We try to. Also the practical while we're in class, while we're teaching, we get those financials and we practically, dissect them. And as I said earlier on, what came out clearly from the analysis of Zenith Bank is that the bank is on a strong footing. And even looking into the future, of course, you can use the past to project the future, particularly since June 2024, when the current management came on board, led by, Dem Adora. I think they have the bank has done tremendously well. If you look at the fact that even the branches they are opening in some other countries, Zenith Bank today is operating in Paris. And since, as I said, she came on board there has been a lot of endorsements.
All right, okay, thank you.
Endorsements by international, by Euro Money magazine, by
thank you. All right, thank you so much.
Magazine. So
okay.
all those are, yeah.
Let's leave it there for tonight. Thank you so much, Professor. We'll be touching base with you in the days ahead. Thank you so much, Professor Uwaleke.